Good afternoon and welcome to the Morrows Monthly update for December. Investors were very happy to see the much anticipated Santa Claus rally in December, despite the month being dominated by concerns over the outcome of budget negotiations out of the United States. An across-the-board positive December saw strong returns for 2012. The Aussie share market finished the year up 15%, while US markets were up about 13%. Europe rose 11%, while late weakness in the yen saw Japan post a solid rise of about 23%. As it was for most of the year, China was the laggard, rising 3% in 2012. After a volatile year in bond markets, global central bank policy action saw bond yields fall across the board, with biggest falls seen in those at-risk Eurozone economies such as Greece, Portugal and Ireland. On the commodities front, oil posted a stronger 2012, rising about 7%, while gold rose a healthy 6% for the year, marking the 12th consecutive annual gain for the yellow metal. The industrial commodities were mostly stronger for the year, although iron ore did post an annual decline despite rebounding from lows seen mid-year. The Aussie dollar had a bit of a wild ride in 2012, following the trials and tribulations of the Eurozone debt crisis and global central bank policy action. The currency finished the year up about 1% against the US dollar. Most of the data out of the US was positive in December after Hurricane Sandy hit the country the previous month. Unemployment continued to fall, industrial production was stronger, and the housing market continued to strengthen. Importantly, lawmakers in the US eventually reached a compromise to avert the fiscal cliff in early January. After confirmation that the Eurozone was officially in recession, December gave some more upbeat data, with manufacturing activity meeting expectations and business conditions in Germany improving. The main negative reading was industrial production, which fell during the month. Chinese data confirmed what appears to be a turning Chinese economy, with most of the major indicators strengthening. Industrial production, retail sales and manufacturing activity all beat expectations, while the inflation rate remains low, giving policymakers room to stimulate as and when required. Domestically, data was mixed, as third quarter GDP growth met expectations and unemployment unexpectedly fell to 5.2%. On the negative side, business and consumer confidence remains soft, as both sectors continue to show concern over the uncertain global and domestic backdrop. The RBA board did not meet in January, although it is expected to cut the cash rate further in the first quarter of 2013. "2012 was a much stronger year than most expected, posting solid double-digit returns. This was despite the uncertain global backdrop, with the ongoing Eurozone debt crisis and political conflict and change out of the US. Importantly, while positive steps have been taken, we don't believe the risks have fully receded as yet. As such, our portfolios remain at their de-risk position for capital preservation and downside protection. We continue to monitor investment markets closely and are ready to move client portfolios to benefit from any market movements. Thanks for your company, and we look forward to speaking with you again next month.